Welcome to the Deep Dive. Today we're doing a high-speed breakdown of the December 5th, 2025 Vivi Money Daily Report.
Right. Our goal is to get straight to the core of what's moving the markets as we head into the end of the year.
And it seems like there's this triple influence at play.
Exactly. You've got, one, the expectation of Fed rate cuts. Two, the just incredible momentum in AI stocks.
And a third.
And third, you have this very typical low liquidity window period for the end of the year. It's a tricky mix.
Okay, so let's start with the biggest piece, the Fed. What are the bond markets telling us?
Well, the U.S. 10-year yield is hovering around 4.0%, but the 2-year is way down at about 3.49%.
Which means the yield curve is still inverted deeply.
Yep, by about negative 60 basis points. And you know, that's the classic signal, is the bond market basically screaming that a slowdown is coming.
So a slowdown's coming, but the market expects the Fed to start cutting rates. How'd that work?
It's because of the weak macro data we've been seeing. Slowed employment, disinflation continuing.
Right.
It all points to the Fed having to step in.
They have the justification now.
They do. So the market is betting the rate-cutting path begins at the next FOMC meeting, December 9th and 10th.
Okay, so that's the optimistic case. But what about the general mood? Is everyone feeling that optimistic?
It's a strange picture. The VIX, the fear index is really low, around 16. That suggests complacency.
Well, not everywhere.
Not at all. You look at crypto, and the fear and greed index is deep in the fear zone, somewhere between 20 and 30.
So we have a calm stock market, but a fearful crypto market.
Exactly. It's a real split in sentiment. And all of this is happening during that low-volume year-end period, which just adds a layer of fragility to everything.
Vigilance is mandatory then.
Absolutely.
So let's talk about where the optimism is concentrated. You mentioned AI and semiconductors.
That's the engine of the market right now. Large cap tech is really supporting everything.
I saw the numbers for NVIDIA.
Yeah.
It just seems unstoppable.
It really does. Trading in that $181 to $184 range. It's just relentless demand from data centers and AI development.
And that strength is pulling up the big ETFs too, right? Like VOO and QQQM.
For sure. But that also shows how narrow this rally is. If those, 5 or 6 big tech names stumble, the whole market picture changes fast.
Okay, let's pivot to the other side of this, to crypto. Despite the fear, how are the core assets looking?
Bitcoin is basically just consolidating. It's in the $92,000 range, moving between $90K and $94K.
So it's cautious, but it's holding.
Exactly. The report calls it multi-directional elasticity, which is just a fancy way of saying it could break hard in either direction. It's not dead, it's coiled.
And what about others like ETH or BNB?
ETH is pretty stable, around 3,100, and BNB is actually showing some real resilience, holding that $900 mark.
The report had a really interesting point on the Bitcoin to gold ratio.
Oh, this is huge. The ratio is at 21.9.
So you need almost 22 ounces of gold to buy 1 Bitcoin.
That's right. And it tells you that capital, especially institutional money anticipating rate cuts, is skipping the traditional safe haven and just going straight for the highest beta asset it can find.
That's a massive risk-on bet.
A massive one. And if that bet is wrong, that ratio could collapse.
Okay, before we get to strategy, a quick word on the really high-risk stuff. The report flagged Anthropic in the pre-stock market.
Yeah, a lot of buzz there. They're reportedly getting ready for an IPO or another big funding round in 2026.
But this isn't like buying NVIDIA on the NASDAQ, is it?
Not even close. These are what we call high-information asymmetry products. You have very little public data, and the prices are, well, they're opaque. It's extremely high risk.
So for our listeners, how do you tie all this together into a coherent strategy?
The main story is simple. The market is betting on AI and major crypto assets being the big winners from a Fed policy pivot.
So in the short term, the next month or so.
It's all about risk management. The report suggests keeping core holdings in broad ETFs like VOO, maybe some big tech names like NVDA, but crucially,
keep some cash on hand.
A lot of cash or stable coins. You need that dry powder to respond if we get one of these sharp, low liquidity drops.
And then looking out a little further, say 1 to 6 months.
That's when you start building positions, but only if the Fed actually delivers on the rate cuts. That would be the signal to start adding to BTC, ETH, and other quality crypto on any significant pullbacks.
This whole thesis really rests on a couple of key triggers then.
2 main ones. First is the Fed's actual statement on December 9th and 10th. It's not just the cut, it's the language they use about the path forward.
The guidance.
The guidance is everything, and the second trigger is any real news on financing or IPOs from those big private AI companies. Anthropic, XAI, you name it.
A deal there could lift the whole sector.
Or disappoint it. It's a huge catalyst either way.
So to wrap it up for you, the listener,
Yeah.
the path forward is this delicate dance. If the economy stays soft, the Fed cuts. And that's good for risk assets like tech and crypto.
But if we get any kind of surprise, like stronger economic data or a jump in inflation, the reason for cutting rates disappears, and that could trigger a very sharp pullback.
And that leads us to our final thought. With the VIX this low and trading volume so thin at year-end, we're in a classic setup for a false breakout.
Yeah, head fake.
Exactly. So the thing to mull over is this. What specific liquidity risk should you be most cautious of right now? Is it a low-volume crypto pump past 100K? Or a sudden gap up in a stock like NVDA? Don't mistake low volume for real conviction.